I was at the New York Stock Exchange with Mike Santoli yesterday. He said yesterday's moves in the market, they were impressively muted, but still we hit new records in the S&P and also the NASDAQ after those Jay Powell comments. So I want to ask you, do we need rate cuts at a certain period of time, this year, before the election, et cetera, to keep the rally going? Or is it only important that we are on the path to rate cuts?
Well, both. I think both are actually true, Frank, at the same time. So, the market is confident that the next move for the Fed is going to be a cut. And so, another way of saying that is just the Fed put is back in place. So that, that part of kind of market confidence is going to be important. But really what Powell was saying there when he's saying he wants to be more confident is he doesn't want to be like Europe. He doesn't want to be like the ECB, who basically talked themselves into a corner in terms of having to cut once and now are kind of indefinitely on hold. And that kind of uncertainty is not something the market really is going to be terribly excited about. And so, when Powell says more confidence, he just really says, I don't want to be ECB. Once we start cutting, once we make that first cut, we want to have a series of cuts coming after that. We want to get back to that measured pace idea from Greenspan in the mid 2000s. That's sort of the ideal for the Fed. And so he's just being a little bit more patient to get there.
One of the things I've been talking to a lot of people about, managing directors, portfolio managers, is rate risk. We're going to show a chart right here that moves on the 10-year compared to the S&P. As we've seen yields kind of spike up a little bit, we've seen the S&P basically move sideways. Are you keeping your eye on rate risk? And if we continue to see yields move up, do you respond? Does that change any way that you're looking at investments?
I think, Frank, if we get to like a 5%, like a 5 handle on the 10-year, then yeah, that can start to move things. If we get a 2 handle, obviously that's going to move things too, because that means we've got a
extremes are definitely going to move things. But what about if we're kind of in this in between part? Like right now, we know we're just under 4.5%.
So I think it's going to change what part of the market is going to be winning. So anywhere between probably 4.5% and 5%, you're going to see tech and big cap continue to win. You get something with a 3 handle on it, you're probably going to see the small caps and the rally broaden out. So, you asked earlier, like if we need if we need cuts to get the rally going, we need rate cuts to get the rally to broaden, but not necessarily keep going.
All right. So obviously AI has really been powering this market. I want to bounce something off of you. Strategist out with a note yesterday saying that tech will have the strongest sales growth rate at 9.5% in this upcoming earnings season, outperforming the S&P's overall sales growth rate of 4%, though they warn the biggest risk to earnings is a shift from AI euphoria to AI disappointment. Are you in that same camp that right now we're at what could be an inflection point when it comes to this AI trade?
I actually think that's pretty timely, Frank. We are going to start earnings season here in a couple of weeks, and the expectations for these companies is pretty darn high. And so, obviously when you have high growth companies that have high growth expectations, the biggest risk is neither one of those or one of those failing. And so, we are getting a little bit more cautious here on the AI trade as we enter these next few weeks. We're very, very confident in it over the next few months. But the next few weeks, we are a little bit cautious that some of these high growth, high expectation names are just not going to be able to quite deliver.